The first stock up is Equitable Group, ticker symbol EQB. Equitable Group serves a growing number of Canadians every day through their banking platform called Equitable Bank. They have grown over the years to become the 7th largest independent Schedule I bank by assets in Canada. EQB offers Canadians a chance to earn high interest rates on their money and not have to pay any fees on everyday banking. Essentially, what this means is that you get to use your money, you get to access your money the way you want, when you want, and not have to pay any fees on how you use your money. And on top of that, they'll actually give you money through the high interest rates to use your money. And this is how they're positioning themselves differently than the traditional banks. EQB has more than 325,000 customers in Canada and is growing every day. Here's some quick stats on EQ Bank. They're in the financial services sector. Their dividend yield is around 2.29% with a very healthy dividend payout ratio at 12%, meaning they have ample room to grow their dividends over the years as they grow their services. The PE ratio is 7.3, and they have a 5-year dividend growth rate at 12%. Anytime I see a dividend growth rate at more than 10%, I'm definitely taking a hard look at that stock or at that ETF to see the underlying results. Not only do you get an amazing stock with amazing growth potential, a great dividend growth rate, but on top of all that, they are undervalued. Today's stock price, which is trading for less than $60 a share, it is 58% undervalued compared to its fair value based on a discounted cash flow model. Equitable Group recently announced that they have entered an agreement to purchase Saskatoon-based Concerta Bank for $470 million. This is a great method for EQB to grow its customer base and expand on their services, while the small regional players offer them an amazing customer experience, offer them great customer service, offer them an alternative to the big banks where you are nickeled and dimed for every little thing. All this leads to some amazing growth for the bank. In recent years, EQB has announced some pretty hefty dividend increases. I'm fully expecting with their low payout ratio, their model for growth, to continue to grow their dividends at an impressive rate. And in even more recent news, EQB has just announced that they have partnered with MasterCard to launch the EQ Bank card. This is huge news coming from the bank as it allows its customers to withdraw cash from any ATM in Canada for free. That's amazing. Imagine you're out and about, you're doing your thing, you need cash. But what happens is that sometimes you'll be looking, hey, I'm with CIBC, so I gotta find the CIBC branch, or I'm with Scotiabank, I gotta find the Scotiabank branch, or I'm with TD and RBC, whatever. With EQB, you can access any ATM in Canada for free. How cool is that? I know personally I've had issues where I have to go to my bank's website and find the nearest ATM so I can withdraw my own money without having to pay fees on it. This is a game changer. And on top of all of that, you get to earn cash back on everyday spending and earn high interest on your balance. There is a growing demand for a bank that offers everyday checking services combined with a high interest rate from a savings account, all with zero fees. EQB launched back in 2016, and now today they boast $7 billion of deposits on their balance sheet. And how have they grown so fast? Well, here's the formula to their success. They combine a high interest account with features of a checking account. They offer unlimited number of Interact e-transfers. They offer free bill payments, and best of all, no minimum balance. Considering how expensive the big banks are for everyday checking services, this makes complete sense to be a game-changing alternative. And as they grow for their customers, as they deliver for their customer experience, investors get to benefit along the same time. They are well positioned for growth ahead, and I'm honestly banking on them for future dividend growth, and it's perfect for my TFSA. Next stock up is StorageVault Canada Inc, ticker symbol SVI. StorageVault Canada is a Toronto-based company that owns, manages, and rents out self-storage facilities and portable storage spaces throughout Canada. And here's why I'm excited about this business. Self-storage is the shortened term for self-serve storage. For example, if you need a storage space for all of your things, all of your possessions, for either short-term or long-term, you're going to be looking for a self-storage unit that you can access hassle-free and access easily, and that's readily available. And that's why this industry has enjoyed strong growth in recent years, and research indicates that this will continue through this decade and possibly beyond. And that should pique your interest behind this exciting dividend growth stock. SVI currently owns over 200 locations with over 11.2 million square feet of rentable storage space on over 660 acres across Canada. Plus, they have over 1.5 million square feet of expansion potential within these locations. This is currently the largest public Canadian storage business and the fastest growing storage company in Canada. And they have implemented a DRIP policy, a dividend growth policy, since 2016. And investors have not only enjoyed capital appreciation along the way, but a growth in their dividends along the way. And this trend is going to continue as long as there is a need for self-storage, which I don't think is going to stop anytime soon. This stock has gone up 155% over the last 5 years. Since April of 2015, they have spent over $2 billion on accretive acquisitions. They are on aggressive growth mode. And just in 2022 alone, they spent $200 million buying acquisitions, growing their customer base, growing their locations to deliver growth for investors. This is a pure cash flow business that does not require a ton of capex to be spent on post-acquisition operations. People will store their things as long as you give them the space that they can easily access, and you get to collect that rental money. More and more online shopping has forced us to buy more and more things. There's marketing every day around us, ads on everyday things, forcing us to buy this, buy that, collecting more and more things along the way. And living spaces, they have gotten smaller over the years. Condos, unless you're in downtown Mississauga, downtown Toronto, downtown Vancouver, 500 square feet, 600 square feet, sometimes they're fitting in 2 bedrooms in about 700 square feet. That's not a lot of living space. So as we buy more things, as we accumulate more stuff, we're going to need space to store all that stuff. This is a beautiful business model. People need to store their things. They will just keep buying more stuff. Condos are just getting smaller, so they will need space to store all their things. You offer them that space, and you get to sit back and just collect rental money. And here are the stats to back it up. Storage has been the top performing real estate asset class in the US over the last 10, 15, 20, and 25 year periods. And in Canada, it has been the top performing real estate asset class, storage, over the last 10 years. And how does this industry keep growing? The answer is simple, it's demand. Populations continue to grow, the change of family circumstances, changing workspaces. If your home is your office, it's your gym, you will need more space, you will need more things. Impulse buying on Amazon, all this leads us to collect more and more things, and we will need more space to store all these things we're accumulating along the way. This is both a growth stock and a dividend stock, and it gives me great diversification in a growing sector. Another perfect fit for my TFSA. And what's the best way to keep track of these amazing dividend stocks? Well, you can now download my custom built dividend spreadsheet that I have developed for investors like you. So you can keep track of your dividend income, your gains, your losses, and even forecast your future dividend income. I would not be able to manage my portfolio without it. So make sure you check out the link in the description below and download yourself a copy today. Next stock up is Brookfield Asset Management, ticker symbol BAM or BAM. Honestly, without even just looking at the details, I just like the name BAM. I would invest in a stock called BAM all day. BAM. BAM is a leading global asset manager with over $750 billion of assets under management. And these assets include renewable power, infrastructure, private equity, real estate, and credit. The objective for BAM is simple: generate attractive, long-term, risk-adjusted returns to not only benefit their clients, but also their shareholders like you and I. Recently, there was a spin-off and Brookfield separated into 2 separate businesses, one for operations, Brookfield Corporation, and one for asset management, Brookfield Asset Management. And if you're wondering which entity makes more sense for you for your profile after the spin-off, well, for investors who are looking for more dividends, more cash flow, then BAM makes more sense because their target yield is 4%. Pre-spin-off, the 2 combined entities had a yield of around 2%. So you can see clearly they have separated the more yield-focused business into a separate entity for investors who want that kind of return profile. And for investors who want to benefit from the operations profile of the business, well, you have the other corporation, Brookfield Corporation, which is yielding less than 1%. So you have 2 amazing choices based on what your risk appetite is, what you're looking for as from an investment point of view. Do you want more dividends? Do you want more capital appreciation? You have 2 amazing choices. It just depends on what you're looking for from your investor point of view. But here's the real cool thing. Brookfield Asset Management offers both growth from capital appreciation and also a nice dividend yield along the way. Management fully believes that they can double the size of their fee-generating business to over $1 trillion over the next 5 years. That will be an amazing growth rate of over 15% per year. And here's why it makes sense. It's a capital light business. The dividend stock has a target payout ratio of about 90%, and it's able to pay out a bigger yield of about 4.3% currently. This is a really strong, pure play asset management business that's a global leader, and it makes a ton of sense for almost any dividend portfolio. With a bigger dividend, investors can get a more reliable return through various market cycles. Humanity will continue to grow. There will be newer and newer emerging technologies, and the beauty about investing in an alternative asset manager like BAM is that they put their money, they put their capital where the future growth will be. So if you want to enjoy the ride of where that future growth will be, wherever it may be, investors for BAM, it makes 100% sense. They have global scale, major capital partnerships, deep operational experience. They have over 100 years of operating experience, close to 200,000 employees working for you, the investor, working hard to grow your money. Do you need any more reasons? This is an amazing long-term dividend growth stock that I will put in my TFSA all day long. I'm constantly asked, what brokerages do I use to handle my very own money? And I'm going to give you three amazing options. One, Wealthsimple Trade is a trading platform where you can make commission-free trades when buying and selling your stocks and ETFs. The $0 commission trading is one of Wealthsimple Trade's killer features. The next best option is Questrade. The fact that you can buy your ETFs for free is amazing. The rest of your investment choices are cheap too, helping you save money while trading. The third option is Interactive Brokers. This is a leading platform in Canada and one of the best options for self-directed investors to access the market. Interactive Broker Canada offers active traders the best deal that they can get when it comes to trading. If you want an easy-to-use UI, a simple and easy-to-use platform for beginners with zero commissions on stocks and ETFs, Wealthsimple makes sense. If you want a little bit more features, a little bit more robust of a trading platform where it offers unique charts and investor insights, Questrade makes more sense. If you want all the bells, all the whistles, a platform that can give you all the tools you need to carry on about your trading activity, then Interactive Brokers makes the most sense. I will leave links to all three in the description below so you can at least check them out, see what they offer, and see if it makes sense for you. Couche-Tard, ticker symbol ATD. Although ATD doesn't have the highest yield around, but it is an absolute powerhouse when it comes to delivering on dividend growth. In the last 2 years, the dividend growth rate has averaged 25% per year. How is it able to do that? How is it able to offer that kind of dividend growth rate? Well, it's backed up by some fantastic revenue growth and strong cash flow. It also helps that it has over 14,000 convenience store locations worldwide and are constantly expanding. Here's some stats for ATD. It's in the consumer defensive sector. It has a dividend yield of less than 1%, around 90 basis points. The dividend payout ratio is 14.9%. It has a PE ratio of 16.27% and has a 5-year dividend growth rate of 21.2%. As I said before, anything with a dividend growth rate of 10%, I'm taking a hard look at. This is double my target. This is 21%. So I'm obviously going to take a hard look at this ATD to see if it's a worthwhile investment. I agree the dividend yield is low, and that might be a turnoff for certain investors. But let me make my case. They have made up for this low dividend yield by offering dividend investors an impressive growth rate. If you're looking for a solid Canadian dividend stock that has deep roots being a market leader in a defensive sector, this pick makes a ton of sense, especially if you're a long-term investor like me. ATD is planning to add EV charging stations to its convenience store locations across Canada, the US, and Norway. This kind of rollout simply would not be possible if it were not for its massive network of retail operations. It has strong coast-to-coast presence across Canada, and it dominates 47 out of 50 states in the US. But it doesn't just stop there. It's also a market leader in many European markets. You can add a strong global leader in your portfolio right now, right from your own backyard. Since 2004, ATD has successfully completed 68 deals, adding close to 11,000 stores globally. The company is well run by a responsible and experienced management team with a proven track record. They started off by buying gas stations, then they added retail operations along the way, all without taking on too much debt. And that's key, because this allowed them to not only grow their revenue, but also their profit along the way. Because if you're taking on way too much debt, guess what? That interest is going to eat away at your bottom line. So here's the key to investing in companies when you're looking for the right mix of growth and expansion. Look at its interest. Take a look at how much debt are they taking on. Are they taking on way too much debt that's growing top line, but it's killing their bottom line? That's the key to successful investing. It recently acquired a car wash chain by further complementing its business. Next is implementing EV charging stations across its network. You can see why this is an easy pick for my TFSA. Long-term growth and some amazing dividends along the way. Next stock up is Fortis, ticker symbol FTS. Fortis is a Canada-based electric and gas utility company. Their business segments include regulated utilities and non-regulated utilities. Fortis serves many different regions including Arizona, BC, Alberta, New York, Newfoundland, Ontario, PEI, and the Caribbean. And guess what? Their dividend growth streak is now 49 years long. When I see a stat like that, that gives me super confidence in the company that I'm looking at as a potential investor, as a shareholder. 49 years of consecutive dividend increases. I love seeing that as a long-term investor. It gives me confidence in the business. It gives me confidence in what management is trying to do to grow that business. because you have to grow that business in a sustainable way. Because the last thing you want is a dividend cut. Here's some stats behind Fortis. It's in the utilities sector. Dividend yields around 4.24%. Dividend payout ratio is 83.7%. PE ratio of 20.47%. And has a 5-year dividend growth rate of 6.1%. Fortis is one of the very few Canadian dividend paying stocks that can be actually called a Canadian dividend aristocrat. With a dividend yield of over 4% and a near 5-decade dividend growth streak, it's nearly impossible to create a dividend growth portfolio without Fortis in it. Over the last 20 years, it has averaged over an 11% annual return to its shareholders through dividends and price appreciation. With a dividend growth streak of nearly 5 decades, on top of an amazing attractive yield of over 4%, this stock is like holding onto a bond, which is great news if you can't have or don't want bonds in your portfolio. Many people around the world, especially in those countries that have harsh or cold winters, they rely on natural gas or electricity to heat their homes during the winter. Or they use natural gas or electricity for cooking purposes. Everybody needs food. This is why Fortis is a very stable stock to own. People need electricity. People need natural gas to survive, to maintain their life, because this is a basic necessity, which we all need. Fortis has dedicated $22.3 billion of capital program on the go that will drive up the rate base in the coming years. And here's why that rate base is so important. It's so key to growth. Because as this grows, this will result in increased cash flow. And as this cash flow grows, this can support the planned dividend increase of 4 to 6% per year through 2027. In a nutshell, as the business grows, this will increase cash flows. That increased cash flow will go towards the shareholders with increased dividends. If you're wondering what is missing from your TFSA, this is worth taking a hard look at. Thank you so much for watching and making it to the tail end of this video. Your support means so much to me to make this content happen. I have offers for you, exclusive offers for you in the description of this video for some amazing discounts, some amazing sign-up bonuses. These are products and services that I use on a daily basis. And I want you to at least try them out to see if they make sense for you. You might find something you like. Do me a small favor, hit that like, subscribe, and thanks button. That's it for now. I'll talk to you in the comment section.